But let me show you something that wasn't tweaked because it was just put out as a general. Let's just go right to the slides. And what you're looking at here is the M2 money supply, which is not the broadest base of money, but the second, versus the CPI, so inflation, consumer price index, versus the GDP. So that's all the money that flows through the US system. And we're going to start on March 1st of 1913. And then the Federal Reserve was installed in December of 1913. And you can see how all of these lines and graphs merge, right? So the black line is the money supply. You can see how much that has gone up. And then the blue line is the CPI, so the inflation gauge, consumer price index. And that line down there is the GDP, gross domestic product. And the reason why I said that this is like the saddest graph is simply because it takes more and more inflation and more money, and the GDP just hasn't lifted off. And so when we talk about the wealth and income inequality, this is really why we have that disparity. Let's go back to that graph, okay? So this takes us through October 1st of 2023, and I mean, you may not realize why it's so sad, but it is really because things are changing and they are going to get real ugly. How much more money printing needs to be done? How much more inflation needs to happen before we shift into this new system? And will it work? No, it doesn't work. Frankly, insanity is doing the same thing over and over again and expecting different results. But after 1971, when this was put into the hands of the central bankers, which is a private corporation, that's when the real shift away from the public began. It actually started back in 1913 when they installed them. But now the U.S. money supply is falling at the fastest rate since the 30s. And I did go back to the 30s. Well, you're going to see everything here. But you can see where this shift occurred. And I'm going back one more time. You don't see anything that major throughout this, even after liftoff. Teeny bit over here, which would have been about 2008, but huge right here. Make no mistake about it. Make no mistake about it, this cannot last much longer. Because if inflation and GDP is supposed to follow the money supply, what does this sudden decline mean for our future? And boy, all of that money printing barely had any impact on GDP. This does just the opposite. So I want you to really think about that. But what is the next thing that's going to happen? Because I consider this also a huge key pattern shift. So it is not an accident that we're watching the money supply shrink at the fastest level since the 30s. And we're also watching more people spending, the velocity of money increasing at that same time. Taken together, it tells me that the hyperinflationary depression has already begun. We just don't see it yet. And what that also means is that time is running short. But I can show you what's happening. And this isn't my opinion. This is data. This is simply data. And I am simply reading the data. That's all I'm doing. And you can read the data too. But these are two huge key pattern shifts. So something very nasty this way comes. Because you got to ask, did the M2's dramatic decline lead to the Great Depression? And is that what's going to lead to the greatest depression that we're now entering? This is the end of the currency's life cycle. So you can make that comparison, right? So this goes back to August 31st of 1969, shortly before, there was already a run on the dollar that was happening, but shortly before President Nixon took us, I know they say this so nice, took us off the gold standard. Oh, well, that's no big deal. Yeah, it is, because he handed over full control to central planners, to central banks. There's 2008. Now, what I want you to notice here is how that CPI was running a bit ahead. I mean, pretty parallel, but still a bit ahead of the money supply. And in 2008, which is when the system died, I don't care what anybody says, it's when the system died, and you can see the shift. And it takes more and more and more money to get greater and greater inflation. And again, has all of this money and all of this inflation has frankly barely moved the needle on the GDP, which could be how that all of that money is distributed to everybody. So forever, the central planners were using that trickle down theory, where is if we give all the money to the people at the top, then they're going to go out and spend it, and it's going to trickle down to all those people, the 99% on the bottom. And it doesn't work, and it hasn't worked, but they still do that. But there's only one way to fight deflation, and that's with inflation. So it makes it really simple. It's not like they have lots of choices. They don't. There are not lots of choices. There's one way. And there's one way to revalue a currency as well, and that's against gold. That's the way they do it. So honestly, it makes it super simple when we're looking at things to determine what is going on and where are we in this trend cycle. Let's go on, because this is the spot price of gold, which some of you watching may have noticed that it went above $2,000 today. And you might even say, whoop-de-doo, isn't that fabulous? But remember, they can create as much digital gold that does not nor ever will exist. They could do it with silver too, through the derivatives market. So let's just look at this long-term chart. Now, this graph is adjusted for inflation. So even though the official price of gold was $20.64 an ounce back in 1915, and today the official price of gold is $42.22. Well, that's not really reality. Back in 2015, from how much new money they printed, so inflation adjusted, it would have been $600 an ounce, even though the face value was $20 an ounce. 1934, okay, they did that revaluation where they revalued this against that. That's always the way they do the revalue, those overnight revaluations. And you can see how rapidly spot gold went up. Here, that was the first revaluation. Then here, then there. Okay, 1970. All right, pushed it all the way down, because after all, they don't want you to know a rise in gold price is an indication of a failing currency. And the US dollar as the world reserve currency was certainly failing on a global basis in 1970. And as I told you before, there was a run on the dollar.